and we'll broaden our scope here to look at all of those monthly indicators that the NBER looks at to determine whether the economy is in an expansion or a recession. So the NBER looks at 6 key monthly indicators to tell them. The National Bureau of Economic Research, this is the official arbiter of the business cycle. When we say that a recession began in March of 2001, a recession began in February of 2020, it's because the NBER says that a recession began in March of 2001 or a recession began in February of 2020. They are the official call on a recession or an expansion. And this group looks at 6 key monthly indicators to tell them whether the economy is growing or not growing. They look at non-farm payroll employment. They look at household survey employment, which is the survey in the employment report that's used to compute the unemployment rate. They look at industrial production. They look at personal income minus transfer payments. They look at real personal consumption expenditures, and they also look at real manufacturing and trade sales. When these numbers decline, that's when the NBER says the economy is in a recession. When these numbers increase, that's when the NBER says the economy is in an expansion. Well, you can see now that 5 out of the 6 indicators, 5 out of these 6 key monthly indicators are in decline, various states of decline. Some aren't declining by much at this point. Industrial production is not down by much. Personal consumption expenditures not down by much. But household survey employment down significantly. Real manufacturing and trade sales down significantly at this point. Ironically, we talked about non-farm payroll employment at the outset of the call here, how weak it's been over the past 3 months, how weak it's been over the course of the past year. Ironically, it's the only one of these monthly indicators, key monthly coincident indicators, that is currently at its peak, that isn't in decline at the moment. And even it is obviously fairly weak at the moment. So based on these numbers, we can't say conclusively that the economy is in recession at this point. The NBER doesn't want to just see declines in these numbers. They want to see depth, duration, and dispersion. They want to see a widespread decline. They want to see a deep decline, and they want to see it last for a significant period of time. These drops have been relatively short-lived to this point. Most of them, or the majority of them, are not so deep at this point. So the NBER wouldn't say just yet that the economy is in an outright downturn. But for the first time in this cycle, we've been talking for more than a year now about the risk to the economy, the fact that the risks are skewed to the downside, the fact that a recession is a significant possibility, a legitimate possibility in the near to intermediate term future. Based on these numbers and based on the very soft trend in non-farm payroll employment, for the first time in this cycle, and this cycle goes back all the way to the spring of 2020, more than 5 years at this point, for the first time, we can plausibly say right now that the economy might be in a recession as we speak here in August of 2025. We've got a very soft trend in non-farm payroll employment. Given the trend in the revisions, we have every reason to believe that it's possible that the numbers we've seen in recent months will eventually be revised into negative territory. No guarantee of that, but it's certainly possible that that could happen based on where the revisions have been recently. And these other 5 indicators are already in various states of decline. The best bet is that we're not in a recession quite yet. The risk is still high, but we're not there quite yet. But based on this trend, these trends, based on where these indicators are right now, it is at least plausible that the economy has already slipped into an outright downturn. So let's move from there into the financial markets and talk about equities, because one very missing piece of the puzzle for a downturn is a decline in equity prices. The stock market itself is a leading indicator. In fact, the S&P 500 is one of the indicators included in the Conference Board's index of leading economic indicators. It's one of the 10 indicators included in that index. It tends to fall before recessions. It tends to rise before renewed expansions. but it hasn't fallen yet, at least not by much. We haven't seen equities give us that signal that they often give us prior to an economic downturn. But we don't always get that signal. Most of the time we do. On average, as this next chart shows, the S&P 500 begins to decline 6 months, at least in recent decades, prior to an economic recession. But there have been cases, 1980, 1990, and also 2020, in which the market didn't start declining until the month of the expansionary peak. In other words, the month in which the economy slipped into a downturn. So it wouldn't be unprecedented if we saw, for example, a recession that was dated to begin in August of 2025, and the market began to fall in August of 2025. The market began to fall this month, or we had a recession dated September of 2025, and the market began to fall next month. So we often see the market falling before a recession. Typically, it falls again several months before a downturn. It doesn't necessarily always fall before an outright downturn.
To watch this month's complete analysis and receive daily updates directly to your inbox, become a member at cycleframework.com.